How's it going, everyone? Happy Easter. Happy Easter Monday. I'm actually filming this on Easter morning and I'm not going to upload it into tomorrow. So if you're watching this on Easter Monday, I hope you all were able to eat delicious foods and treats and spend time with your family and friends while celebrating the resurrection of Jesus. And what better topic to talk about on this holy day than how corrupt and stupid our government and monetary system are? Man, I could talk about that all day. But today, in this video, I'm going to specifically talk about the Federal Reserve and inflation. And I'm sorry if this is going to be kind of like a treatise of a video. By the time I'm done filming and editing it, I have a feeling this one may be a long one, but I have a good amount of information to share, and I think that it's information that's very important. And if you're a gold and silver stacker and you're worried about the economy, you're worried about inflation, you're worried about these crazies at the Federal Reserve and what they're going to do, but you don't have all too great of an understanding of it, and you're a little confused and have some questions, hopefully I can answer some of those questions in this video. So if you're one of those people, I recommend watching this video in its entirety because I feel like you may get something from it. So where is the inflation? People are saying inflation's low. These idiots that said Federal Reserve policy was going to lead to inflationary death spiral, they're idiots. They have no idea what they're talking about. They were wrong. See, there's two possibilities with people who make comments like these. One, they don't understand what inflation is. Or two, they understand what it is, but they just don't want you to understand what it is. And there's obviously people who would prefer if the general public had no idea what inflation was, because if they didn't care, then they wouldn't have changed up the definition on us. When most people talk about inflation, they talk about rising prices. All right, I've talked about this on my channel before, but in case any of you are new and aren't up to date, inflation is not rising prices. All right? Inflation is the expansion of the money supply. When these people talk about inflation and rising prices synonymously, they are wrong. They're using the wrong word for rising prices. That is not what rising prices is. If the Federal Reserve creates more money and injects it into the economy, and there is not an increase in productivity of goods, if we can't create a larger supply of goods, you have more dollars chasing the same amount of goods. So supply and demand, prices will rise. Not in every case. For instance, in the late 19th century, it was actually inflationary. We were still engaging in fractional reserve banking, which is very inflationary, but prices declined during that time period because despite the inflation, we were still using a semi-sound system of gold and silver as money, and people were actually saving a much larger percentage of their income back then than they are now. So even though we were engaging in inflation, prices still decreased because we were very productive, because we were using gold and silver as money. We had a relatively free market. People were saving a lot of gold and silver to invest. So despite the inflation in the late 19th century, prices still declined. So they're not synonymous at all, whatsoever. Now, although the inflation of the late 19th century didn't lead to rising prices, what it did was it prevented prices from falling as much as they would have if the inflation wasn't there. And it still led to malinvestments in the economy, which in return led to events like the Panic of 1893 and 1907. Now let's talk about the inflation. Where is the inflation? Well, you can see we've had high inflation in certain areas of the market and of the economy. And this inflation, which got injected into these markets, caused rising prices. So you can look at the stock market. You can look at the bond market, the auto market, the student loan market. The price of going to college is extremely high now, especially for all these left-wing universities that actually make you more stupid than you were than before you attended them. And we're also seeing a lot of inflation in the real estate market, even the crypto market. All these things have increased in price significantly since 2008. So what do all of these things have in common? Well, they're all functions of debt. People borrow money to buy these things. Yes, even stocks, bonds, and cryptos. All those markets are highly leveraged. Companies over this past decade have been borrowing money, and you can see that by corporate debt being at an all-time high, companies have been borrowing money and using that borrowed money, that cheap money that the Federal Reserve created, to buy their stocks back with it. These debt-financed stock buybacks, which have been happening at large scale for the past decade. That's how that money got injected into that sector of the economy. How about the bond market? Well, the Federal Reserve created trillions of dollars and used a lot of that money to buy bonds. How about houses? People take out mortgages. People are borrowing that money to buy their house. Same thing with their cars. They don't pay cash for cars, at least most people don't. They borrow money to buy their cars. And the money that they're borrowing is the money that the Federal Reserve created out of thin air during the financial crisis. So you can see the inflation right in front of your eyes. You just have to look in the right spots. But all of this still doesn't explain why Federal Reserve policy didn't cause the inflationary spiral that some people were warning about. This inflationary spiral hasn't happened yet. And the key word in that sentence is yet. Because the Federal Reserve, with their Keynesian trickery, were able to figure out a way to kick the can down the road even further. To once again postpone the day of reckoning. And that's because in 2008, the Fed changed the way they do business. Congress passed legislation authorizing the Federal Reserve to start paying interest on reserves and excess reserves. All right, this is a very important key. So what happened was, during the financial crisis, all these banks and other institutions made terrible lending decisions, which were influenced by artificially low interest rates by the Federal Reserve under Alan Greenspan. So all these banks lent people money that they weren't going to be able to pay back. And some banks invested in these mortgages in the form of mortgage-backed securities. All these are just mortgages clumped together. And this was a terrible investment because the people weren't going to be able to pay those mortgages back. So when the housing crisis started, people were going into default. These banks were in serious trouble of collapsing. So what happened was, and this really gets me, people say that the Fed doesn't create money. Yes, they do. They do create money. The Federal Reserve created roughly $4 trillion out of thin air and used those dollars to buy U.S. Treasuries, mortgage-backed securities, and government-sponsored enterprise obligations like Fannie Mae and Freddie Mac obligations. They did this to bail out the market. They're like, oh, you guys invested in these bad mortgages. Here, give us those toxic assets. And here, take these trillions of dollars. It's not a big deal. We can just print it out of thin air whenever we want. That should fix everything. Also, in essence, what had happened was Wall Street bailed out the U.S. government by buying their bonds, and then the Federal Reserve bailed out Wall Street by buying the bonds off of them. By the way, they can't purchase treasuries directly from the Treasury. Right? They have to purchase them through other banks. Right? They basically use other banks as their treasury broker, as their middleman. So they gave all these banks and businesses trillions of dollars. Now, this is where it gets tricky. And this is the main reason why we haven't experienced that inflationary spiral yet. Keep in mind the word yet. The money that the Fed gave these institutions for those toxic assets, right? The Fed was like, if you keep that money locked up here at the Fed, we'll pay you interest on it. So that's what they've been doing. They created all this inflation, and they've been paying the people that received that inflation not to lend it out. Most of the inflation does not happen when the Federal Reserve creates electronic reserves. Most of the inflation happens when we lend that money out because we engage in what you call fractional reserve banking. And that's even more inflationary than the money that the Federal Reserve creates. So what fractional reserve banking is, basically banks are only required to keep a small percentage of the money that is deposited in their bank, and they can lend out the rest. So right now, I believe the reserve requirement for most banks, I think it depends on how much money you have deposited at the Fed. But right now, I believe the reserve requirement for banks is around 10%. So if somebody deposits money in a bank, that bank has to hold on to 10% of that money, and they can loan out 90% of that. And this is where most of the money is created, by the commercial banks themselves, by banks like Bank of America, Citizens Bank, TD Bank, whatever. Not at the Fed, but these banks create the most inflation. Because if somebody deposits $100 in a bank under our fractional reserve banking system, and then that bank goes ahead and lends out $90 of that $100, right? So this guy borrowed $90, this guy deposited $100. They both, right, see in their account balance, this guy sees $90, this guy sees $100. And they can both withdraw that money on demand. This is how commercial banks create money. They turn $100 into $190. And it gets even worse. It gets even worse because when that money is spent, right? When that guy spends his $90, when this guy spends his $100, whoever receives those dollars then deposits it in their account. And then that bank can lend out 90% of that. And so on and so on. It's called the multiplier effect. So I've heard people say, the Fed only printed $4 trillion. We have a whatever $1 trillion economy. It's going to be nothing. Well, you don't understand. Yes, they only printed $4 trillion, but if that money gets lent out, it's going to turn into way more than $4 trillion. So most of the inflation happens with the fractional reserve commercial banks themselves. Like I said, the Fed has been paying these banks not to lend this inflation out. This is unsustainable because eventually people are going to be willing to pay a higher interest rate than the Federal Reserve, right? And when that happens, when this money gets out of the bag, it's going to cause serious inflation by the multiplier effect and cause high price inflation because all that money will be multiplying. And the Fed can't keep raising the interest on excess reserves in order to prevent that from happening. They can't keep raising rates because that will hurt their profitability. Therefore, they will be remitting less cash to the Treasury at the end of the year, meaning that the government is going to have to go into more debt and that their debt would be unaffordable. And they can't suck this money out of the system like they've been trying with their quantitative tightening, right? They've been selling assets off to pull that money that they injected into the system back out. But if they did that, if they sold these mortgage-backed securities, or if they sold these U.S. Treasuries, interest rates would go through the roof, bond rates, mortgage rates, right? It would severely hurt the real estate market. It would severely hurt the government and hurt the affordability of their debt. It would send us right into a major recession. And I've been saying this all along. And I was right all along because what is the Fed doing now? They're dovish. They're saying that they're going to stop shrinking their balance sheet by September. What I think they're going to try to do is start another round of quantitative easing. Or maybe they'll call it something else this time to keep people fooled or whatever. But they're going to start quantitative easing again and injecting more money that they're creating out of thin air into the banking system in order to push down the federal funds rate, which is the rate that banks charge each other when they're borrowing from other banks overnight usually. And they're going to do this because for the first time ever, see, the way they keep that money in the banking system and price inflation under control is that they pay a higher interest rate on those excess reserves that the banks have deposited at the Fed than they would if they lend it to other banks. So they have to keep the IOER rate higher than the federal funds rate. If the federal funds rate goes above the IOER rate, that's when that money is going to come out of the bag. And banks are going to be looking for higher yields by lending it to other banks and regular people. And what just happened for the first time since the financial crisis, happened in March, I believe, the federal funds rate did tick up above the IOER rate. So I, myself personally, am expecting a jump in the CPI because this money that the Federal Reserve printed all those years ago is still in the system. At least most of it is. And banks are just starting to lend it out. So don't listen to all these people who have absolutely no idea what they're talking about. Oh, what the Fed did didn't cause inflation. Where's the inflation? I don't understand. Japan has negative interest rates. Where's all this inflation? You're going to see the inflation. If you don't see the inflation, then we're going to see an extremely just catastrophic recession. And hate to be blunt, I hate to be negative, just speaking the truth. Just being in touch with reality. And really at this point, unfortunately, it seems like it may be probable that we'll experience both high inflation and recession, an inflationary recession. And I don't know exactly what's going to happen, you know. I'm no Austrian economist. Even Austrian economists don't know exactly how it's going to play out. I'm just a guy sitting in his room, bashing on the state and just staring and loving my precious metals. But I know that the Fed is in a pickle that they can't get out of. There's two options: high inflation or catastrophic recession. Which way are they going to choose? I feel like they're Keynesian, so they think we need to spend more. So I have a feeling that they're going to let the inflation out of the bag. And when that happens, they're not going to be able to reel it back in. So all I know is during these uncertain times, I feel very comfortable storing my wealth in gold and silver. So like I've said before, I don't stack precious metals because I think the value is going to go up. I don't stack it because I think silver supply is going to decrease and industrial demand is going to increase and the value of silver is going to go through the roof, or the value of gold is going to go through the roof. I think it's possible, but that's not why I'm stacking it. See, I'm not a gold and silver pumper. I am an everything pumper. I'm a canned tuna pumper. I'm a sugar pumper. I'm an oil pumper. I think everything is going to increase in price. Everything. Unfortunately, I have a feeling that we're about to experience some 1970s style price inflation, but on steroids. So all I can recommend is keep building your skills, keep expanding your knowledge, but I'm doubling down that I am bullish on gold and silver. All right? Because we have Keynesians trying to control our economy, and they're saying, oh, we don't have enough inflation. What do you think they're going to do? All right, so keep on stacking. Keep on preserving that wealth. Thank you to everyone, once again, who watches my videos. I appreciate it so much, and I'll talk to you later.